Okay, everybody, it's me, Gregory Mannarino, and you must say, it's pretty exciting. It is pretty exciting to see this freaking, shit show play out, honestly. Friday, April 29th, 2022, I have 2 pages of things that I would like to talk to you about. Let's start off with this right off the top. The S&P 500 has breached to the downside its recent low, that 4150 level that I've been talking about since last Friday. That, my friends, is a bearish sign. Well, look, we sat back, we watched it play out, and that's where we are now. Keep that in mind. We'll talk more about that in just a minute. What sent the markets lower today? A few things, but one pretty big. What was that? Well, we understand that the rhetoric and the saber rattling between the United States or the Biden administration and Russia is literally getting out of control. We also understand, and we just talked about this yesterday and today, that the Biden administration wants to fund the war in Ukraine over there to the tune of another $33 billion through September, on top of the $15 billion that we've already sent. Come September, he's going to ask for more money from Congress and from you to fund the war. Well, Russia came back and has now threatened to strike U.S. interests if they are provoked, and the market did not like it. As a matter of fact, earlier today, the S&P 500 was nicely in the green. As I said this morning, the setup for the market was not bad. We had stock futures lower, not by much, but we still had 10-year yield stable, weaker dollar, crude oil getting bid up. The market wasn't bad. Market responded positively, and then of course we get this news here. And look, I don't think this should surprise anyone. Not only are you going to hear more stories like this, more threats from one side to the other, it's just a matter of time, in my view, before this war now escalates further. All right, they now have this mechanism in place. You have nations around the world, including the United States here, vastly increasing their military budgets, and that's a mechanism. Again, where does this cash come from? Do we have it? No, we don't have it. It has to be borrowed into existence. Imagine my shock here. All right, so that's why this market took a hit today. That's the real reason behind it. More rhetoric, saber rattling, direct threat from Russia on U.S. interests as the United States continues to fund this war, along with other nations around the world, Europe as well. Anyway, you know the game. You're watching it play out, and it's going to get a lot worse. Now, the fact is, people, we did breach the 4150 level on the S&P 500. This is not a good sign for the market. What we should expect now is this market to fall further. Unless something happens, you get the plunge protection team or some other event occurs. Look, the economic news is abysmal, and we got more that I want to cover with you. But before we get there, I want to stick to the market a little bit more. So cryptocurrencies did fall into some pressure today. Bitcoin around 38,000. Gold put on a gain, not much. Silver got hit. Crude oil still around $105 a barrel here. But the fact of the matter is, the market doesn't like the dynamics that are in play right now, and this potential for an escalating war, much wider war. That if this war, and it seems like the pieces are in play right now, does expand a lot more, and there's direct involvement. If, for example, Russia follows through and directly strikes a U.S. target of interest, this market is going to take a much bigger hit. So, with that said, look, the market is a risky place to be. No surprise, I don't think so, but at least I believe if you spread out enough, meaning you're in risk-off assets at the same time, physical gold and silver. Forget about the derivative. We know how it gets priced. You have at least some cryptos in your portfolio. You're okay here. Not that you're going to do fantastic. Okay, the last several months, 4 months, have been terrible for this market. There's no doubt about it. And with the way things are moving, especially since we breached that 4150 on the S&P, well, we'll keep our eyes on these things. Now, let's move forward. So we found out today that U.S. factory manufacturing activity unexpectedly fell. I love that word. In April, the Chicago PMI Purchasing Managers Index also fell unexpectedly. This is proof that the economy is, in fact, not that we need proof, because we were just told that our economy is shrinking. You and I knew this already from a very, very long time ago. We also found this out. So you and I have covered this at length, but we're going to talk about it again. The money velocity, the rate at which cash is moving through the economy, has been near historic lows for a very long time. Well, the money velocity just took another leg down. Again, you cannot have a booming economy or a recovering economy if the rate at which cash is moving through the economy is not moving higher. That should make sense to you. So again, the money velocity falls yet again. And think about this. The Federal Reserve right now, just in the last month, has added 9% to its balance sheet. And that's kind of an interesting thing because you know the mechanism. The issuance of debt through one door, buying it back through another door. Massively inflationary. Meanwhile, the dog shit lie that the Fed is going to do anything about inflation is continuing to be fed to you and me by the bucketful about how they're going to raise rates meaningfully moving forward. It's going to do a damn thing about inflation. No, it's not going to do anything. Oh, yes, it is. It's going to cause inflation to go higher. As a matter of fact, year over year, overall, inflation is higher by 25%. Forget about their number. They're 8.5%. Now, we're at 25 year over year, but you're not supposed to know that. Anyway, I want to talk about this too before I let you go. Understanding that debt around the world is skyrocketing at its fastest pace ever. And we have the Federal Reserve, the US dollar being the world reserve currency, raising rates incrementally. Those incremental nudges higher in the federal funds rate increase the cost to service the debt. So what I want you to understand is the Federal Reserve choosing now to be doing what they are doing with, again, has nothing to do with inflation. They have no intention at all to slow the pace of inflation. They're fueling it by their current actions. You all know this. I covered it a million times. By keeping the rate suppressed below the actual rate of inflation, which is out of control, they're guaranteeing more inflation. And the fact that the Federal Reserve is in here right now, raising rates, increasing the cost to service the debt, do you realize the pressure that that's putting on not just the United States, but nations around the world, being that the dollar is the world reserve currency, the pressure that that's putting on U.S. consumers, U.S. households here, the middle class as a whole? It's out of control. This is all of this. There's many moving pieces to what's going on right now, and all of it is leading towards the climax, people. That is the bursting of the debt bubble, a cratering of the stock market, a crash of the stock market beyond anyone's wildest dreams. You know this. I've been telling you for years. The implosion of the debt market is going to occur at one point. It's going to melt down the stock market. Cash is going to move into commodities. I also believe into cryptocurrencies. You know that. I've been telling you this for the longest time. This is all leading to a climax. And the fact of the matter is, and I've told you this repeatedly, the pressure is going to be poured on harder and harder and harder on the average guy and the average girl who's just trying to make ends meet. By design. By design, people. I think that's really important. I don't think it's a topic that anyone is touching on. The fact that the cost to service the debt is it's astronomical. As of right now, the latest data on this is the end of 2021, where it was costing nearly $400 billion to service the debt. With rates going up now and the federal funds rate moving higher, you can only imagine what that means. Well, I think it's pretty simple to figure out. Anyway, people, look, so that's really the story right now. The biggest thing, in my view, is that we have breached that 4150 level on the S&P. We should expect to see more losses in this market. Let's see what they pull off. I mean, it was interesting to see this market, S&P 500 in the green earlier, and then all of a sudden, you know what? You want to throw tens of billions of dollars to support that war. Russia's counter is, okay, fine. That means that there is a possibility that they will strike U.S. interests. And that, my friends, would send this market off into who knows where. Anyway, it's not going to be pretty if that does happen. I just want you to understand that. But I'll tell you something else that was interesting today. Despite that, the 10-year yield remained stable. Okay, and there wasn't that usual safety trade where we saw the 10-year yield come down, nor did the U.S. dollar nudge higher. So it's kind of interesting. Let's see what happens. And moving into next week here, now that we've breached that level on the S&P, that becomes resistance. So what's going to happen, maybe the market will try to break above that. And if it attempts to and fails, stocks will go lower. That's the way it goes. All right, people, what else should I tell you? I think I covered pretty much everything I wanted to. I want to hear from you as usual. You know what today is. Today, my lovely friends, is Friday. And that means that you and I are going to do what we do every single Friday together, right? Bring it in. Nobody's looking. Ready? Love each other. Care about each other. Be charitable. I will see all of you Sunday for my markets and look ahead. It's going to be a doozy. And, well, that's it. Have a great weekend. Stay safe. Love you a lot.